this computer? Yes, sir. All right. This is what I'm going to essentially be going over. There's going to be certain things that I want to share with you guys. And as you guys saw by the schedule, let me go ahead and show the schedule really quickly. And the schedule will essentially be this. It will be analyzing momentum, analyzing volume, direct and indirect relationships between pairs, counter retail trading, liquidity targets. I might move sponsored candles and mitigation up to day 4 simply because of the actual technique that I use for it. I want to get a little bit I want to kind of use it a little bit better for you guys. Inefficiencies, which is definitely going to be covered today. Fair value gaps may also be moved to day 4, but we'll see. And finding entries will definitely be moved to day 4, but combination and backtesting so far will definitely go if we have time. There is a hard cutoff today at 10 p.m. as I have a couple other meetings to go to today, so I'm going to be cutting it off at 10. But apart from that, I think we can all make really good use of this. All right, cool. So let's get started with the first share. Let me stop sharing real quick, and then I'm going to start sharing my phone. Perfect. Okay. So the first thing we want to go over is momentum, right? And momentum is a fairly simple concept. Momentum, a lot of people, when they are taught momentum, they are taught it in a very strange way, in my opinion. And the reason because of it is that they're not taught how to look at momentum in the way that you would normally think. They are essentially taught that if price, let's change the color here really quickly. They're essentially, they essentially are taught that price moves in a way that you essentially see, if you see price moving very strongly to the downside, then retracing and going back down, this is momentum, right? So now you are confirmed that you have a bearish structure. To me, this is very silly because of the fact that instead of getting an entry here or getting an entry up here, you're essentially waiting all the way down here to get a confirmation. Now, I'm not trashing confirmation. Confirmation is something that we all use, and I think we can all say that all of us use. However, I don't think that waiting for confirmation at the very end of a move is a very smart tactic. So for me, how I like to measure momentum, it's a very simple way, and it's something that I think is going to help you guys out a lot. So you guys know how banks essentially move price, right? You guys know that there has to be a willingness to buy for there to be a willingness to sell, right? So essentially, say if price takes off from down here, right, consolidates and then shoots, there has to be a willingness to sell as well as a willingness to buy, right? This is going to come very much in handy later. So make sure that you guys are, that you guys know this, okay? That you guys remember this theory, right? So essentially, it doesn't matter how many sells there are, as long as there are sells to balance out the market, because the market likes to be in equilibrium, right? So when we're looking at price, let's say that price ends up doing something like this, right? Let's say it shoots up. And let's say we're on the 1-hour chart, right? Boom. And then it actually shoots back down. Well, it doesn't shoot back down, more like it just kind of makes its way back down, right? Let's say you have an order block right here. So this is going to be your target, right? This is going to be your target from here all the way out here. Perfect. And then you're going to target it, and then it shoots back up, right? Boom, boom, and then you continue all the way up. Now, there's a very simple way for you to distinguish momentum in this position, and it essentially means with how much willingness to buy or sell there is, right? So, and do you guys remember our third law, our third fundamental law of trading? Does anybody remember that?
Time and price correlate.
Right, exactly. So the third one is time and price correlate, right? Time and price correlate. And since time and price correlate, you essentially want to notice a couple things. Essentially, Each candle in this chart, right, is 1 hour. Obviously, we're on the 1 hour chart. But let's say it took 15 hours for price to shoot up. And let's say it took a whole day, 24 hours, for price to move back down. Which one was easier for banks to move? The move that moved faster or the move that moved slower? Which one had the path of least resistance? And this is coming from a physics perspective, right? But I'm going to bring it into foreign exchange. The path of least resistance is essentially which path took least resistance? Which path did banks just kind of slice through? Which one was the path of least resistance? So we're going to take another term here, okay? Is going to be path of least, oops, it's not an L, least resistance. Okay, which one was the path of least resistance? Expansion B, which is this one, or expansion A, which is this one? Which one do you guys think took the path of least resistance? And drop your answers in the chat, please. A or B? A or B? That is the question. A or B? And please, if you guys would like to unmute your mics and explain why, you definitely can.
I'd say A, due to the fact that there's it bounces off the less resistance areas. You know, it's more of a smooth pass upward. But the 24-hour phase B is very rigid on the way down.
Okay, perfect. So as you can see, right, it took 24 hours for the move to move downward. Now, thinking about a rule here, how time and price correlate, if it takes more time for a position to move the same amount of pips from one side to the other, which one do you guys think that will move the path of least resistance? Obviously, it's going to be the 15-hour. Whoops. The 15-hour move, or expansion A. The reason for that is very simple. If we look to the time to price ratio, you're going to see that over 15 hours, it moved the same, if not more pips than expansion B, right? So you can see that expansion A started at this point and ended at this point, and it took 15 hours for price to move there. However, on the contrary, expansion B moved from here to here, less amount of pips in 24 hours. That means that it had to encounter some sort of resistance on the way down, whether it be mitigation, whether it be whatever it may be. It was definitely a path of most resistance, or a path of more resistance. So the path of least resistance was held by the 15-hour expansion. Why? Because momentum held in that direction, and you can essentially use momentum for yourself to check where price is going. Right? So this is another confluence that you guys can use, the time to price ratio. Okay? And time to price ratio essentially is what I just explained. Which path leads to more resistance? Which path leads to less resistance? And all of you guys can see the whiteboard, right? Cool.
Yeah, we see it, James.
All right. So let me check the writer's notes. Right. So this type of momentum should be a confluence, right? Momentum should not be something that you guys base your whole strategy off of. It should be a confluence, right? So say price is approaching this position right here, right? And when you're approaching this position, which, like, let's say again, how we explained it was that this was an order block, right? So we explained that this was an order block, and that's why price moved off, right? Once you're approaching your order block, you can use this as a confluence, because a lot of people don't know most of what they're doing, right? And they say, well, why would price bounce off of there? What range finding tool would we use apart from the order block to tell us that we should be looking for buys around that general direction? What price finding tool are we going to use?
PD array.
PD array, perfect. Let's say that this is equilibrium. Right, let's say that this is equilibrium. Where did we drop below? Into discount. And above it, we sold off at premium. Perfect. So now that we have this equilibrium line, we can tell that below it, there's only one point of structure which actually holds valid, which is this order block. And that's why that order block was our confluence, right, to continue going up. But we also saw the time to price ratio. At this point, we saw that it took a lot more time and price is finding a lot more resistance to the downside rather than to the upside, right? And this is also a way that you can distinguish an impulse move from a simple retracement, right? Because if it moves a short amount of time in a very, in a very slow manner, usually it's a retracement, okay? And let me show you what I mean. And now there's a difference in it. I will actually explain this in 1 second. So there's a difference between these two terms that I will be explaining very shortly. So there are two, which is a retracement versus sponsored. Whoops. I don't know why I'm lagging so much. There we go. Sponsored. Perfect. So now we have a retracement versus a sponsored candle. And essentially the thing that is a retracement is, let's say we took a look at price when it goes this way, right? Let's say we take it this way and then analyze the time to price ratio. Okay, so usually these retracements will take 2-3 candles, while these moves will move a lot more, right? The impulses will move a lot more in a shorter amount of time. Let's say that you traveled a total of 6 candles in, let's say, the 1 hour chart for simplicity's sake. You are now saying that you moved, let's say you moved around, 200 pips. 200 pips, and these aren't real numbers, it's just a guess. 200 pips in 6 hours. 200 pips in 6 hours. However, you moved, let's say, only 30 pips in 4 hours. Which one has the higher price to time ratio? Which one moved more? Obviously, the impulse moved more, right? The impulse moved more because its time to price ratio is a lot higher. And because these time to price ratios are much higher, you can very, very easily distinguish that this is a retracement, not an impulse or a reversal. And you can even use this on lower time frames because you can say, like, okay, let's say on the 1 minute chart, right, which we use a lot for entries. Let's say on the 1 minute chart, we see that it took 4 minutes for price to move up, right? But it only took 1.5 minutes for price to do this. Now, when it starts retracing very, very slowly, what are we going to expect? Where's momentum showing us that price is going, up or down? Is this simply a test of structure down here? Are we targeting up here? Or, on the contrary, are we retesting this up here and we are targeting down here? Which one do you guys think? Green to red or yellow to blue? Remember, time, it took a lot of time. It took 3 minutes. It took 3 minutes to move up. and it only took 1.5 minutes to move down.
Green to blue.
Green to blue. Why do you say green to blue?
Because it only took, you said 1 second.
Well, green to blue isn't an option. It's yellow to blue, or so essentially you're saying, like, let me label these. So like A or B. Which one do you guys think is the most prevalent one here? AA or BB?
BB.
BB, right? Perfect. Why? Because time-wise, it had a lower time to price ratio because it moved a shorter amount of distance over a longer amount of time, meaning that price took the path of most resistance. Which one had the path of least resistance? The one with 1.5 minutes, right? So you can put path of least resistance, okay? And the path of least resistance essentially shows how price is going to move in that direction in the future. Right, backtest. This is almost the same amount of thing. This is almost the same as a PD array. This is the same as a fib retracement. How it predicts what price is going to do is where it's going to go, depending on the price to time ratio. Okay. Now, these retracements are different from sponsored candles. Sponsored candles will essentially do something like this. Sponsored candles will retest structure very, very violently, and I'll explain how. So let's say structure has an inefficiency up here, right? Let's say it has an inefficiency. Now price, Now price has an inefficiency from here. Actually, let me delete that. It has an inefficiency from around here. I'm trying to draw this correctly. From here to around here. Okay. And I will explain what an inefficiency actually is in a little bit, but let's just pretend that this is an inefficiency, right? Inefficiencies are usually filled to the 50%. So price in a mitigation candle, what it'll end up doing is it'll end up doing something like this. Okay. Or it'll do like 1, 2, 3 candles and then drop. And then continue where it was going. This violent retracement, if it targets previous structure, is not exposed liquidity. Okay. Exposed liquidity is only exposed liquidity if and only if it does not target previous structure. Then it becomes a price inefficiency. Okay, and I will explain to you what those are. Essentially, if price returns to a certain point of structure that it needs to mitigate, it will become a sponsored candle, which essentially banks move in such a way that price will shoot to that position, fill in previous structure, and then drop back down. So let's do a little checklist. Okay, if everybody has this, let's do a little checklist. For a sponsored candle, price has to be retesting. So sponsored, so like SC or OC, a lot of people will consider it an OC. An OC is just an outcome candle, right? An outcome is the same thing, it's just, you know, a different name. So let's write a checklist. Okay, and the checklist will essentially consist of must retest previous structure, must happen violently, or it will target liquidity. Okay, and this is very, very easy to kind of tell because the retest of previous structure, it can be order blocks. I've seen this a lot on order blocks, and then people will say, well, why isn't that exposed liquidity? Because it targeted a previous point of structure. Okay, so let me give another example if everybody has these written down. Okay, and to repeat them if you guys can't read my handwriting, it's must retest previous structure, must happen violently, and it must be targeting liquidity. Okay, so let me give an example. Let me say that price has gone up here. Okay, and now it's made its last upward candle before a move down. Okay, what is this known as?
Order block?
An order block. Sometimes price will do something like this, and let me actually redraw that so it can be a little bit closer. Perfect. Where do we put our entry for our order blocks? This should be review from part 2. Where should we put our entry and where should we put our stop losses?
After 50%.
At the 50%. There you go. 50% SL at the top of the wick. Perfect, Angel. I love that answer. Good answer, you guys. So now we put our stop loss behind here. A lot of times what a sponsored or a mitigation candle will do is it will essentially do something like boom. It will either close a wick here or it will close a full candle. And then the next candle will follow it by continuing to fall. Okay, therefore continuing or forming a continuation and supporting structure. What was this sponsored or very violent mitigation candle targeting? It was targeting the 50% of an order block, taking out liquidity, right, which could have been all this, taking out liquidity, right, screwing up late buyers by hitting their stop loss, screwing up late sellers by hitting their stop loss, and screwing up those quote unquote snipers that were hit at the top by hitting their break even. Okay, so either way, all three ways, you are getting screwed over if you're trading retail, right? A lot of people may consider this a break and retest or whatever. Sure, you can consider it a break and retest, but a lot of people wait for 7 different confirmations before a break and retest. And by the time you've done that, the move has already moved 40, 50 pips, and now your stop loss is giant. When you could have gotten the entry off of your sponsored or outcome candle, right, targeting previous liquidity, a small stop loss, and now your target is below these lows. This is TP1, right? Below your lows is TP1. So TP1 got hit. That was an awful line. So TP1 got hit, right? And now you can use your fib retracement tools, fib extension tools, so you can catch your further take profits. Be down here, and further down below. Right? Does that make sense for everybody what a sponsored candle is or an outcome candle?
Yes.
Sponsored or outcome candles, right? That's essentially what they are, okay? Now, do we understand the difference between a sponsored candle and a retracement? Now, how can we tell that this right here, depending on time to price ratio, is not the actual move? Can anybody tell me?
Because it's targeting previous structure.
Right, it's targeting previous structure. But there's one more confluence that you can use, and I'm about to show you what it is. So welcome to our section known as please explain the difference between sponsored and retracement. Okay, so essentially it's the purpose of a retracement, right? A retracement, let's say, let me actually write this down. So a retracement will have low time price ratio. It will generally also have low volume, and I'm going to explain this a little bit later. And it will also, it will target lower time frame structure. It will target lower time frame structure because there is no higher time frame structure to actually test. And it will usually mitigate losses on minor candles, and I will explain that in 1 second. Okay, versus a sponsored candle, which I will show right now, where here you go. This is the sponsored candle checklist, right? It must retest previous structure. It must happen violently, and it must target liquidity. Another note would be high volume. Actually, no, it won't have a high volume. It will also have low volume. But we'll target higher time frame structure. That makes sense? Make sure you guys mute yourselves. Perfect. Does that make sense, Angel? I hope that does. Perfect. Let's move on to our next point, which is volume. Now, volume is something very, very important because you will have something known as volume profiles or volume divergence. And volume divergence is extremely important for you to understand as a trader, because if you don't understand volume divergence, you usually will not get the correct moves, right? A lot of times the moves that you take will end up being the wrong impulse. A lot of times the moves that you take will also end up being the incorrect kind of point of interest, right? And that's essentially what you want to have. Give me one moment. Let me pull that up. Give me one moment, guys. Perfect. Okay. So now volume is extremely important for you guys to understand. So let's go over it. Jesus Christ, that's horrible. Volume. There's a couple noteworthy things about volume. Essentially, you can get it on TradingView. You really just have to click the volume setting, and I'll show you right now what it looks like. So if you go to TradingView, all that you really need is, let's say you go to gold, whatever. You can get it by clicking on, where is it? Indicators. And when you hit the indicators, you should see volume. So you just literally just type in volume and then you click it and then you can add it, right? There really is no difference between bullish and bearish, like the colors. It's really just volume. Like that's what it should just be, volume. Because what I'm about to show you, it really doesn't matter what side it's going to. It just matters if there is or is not any volume. Okay. And I will go back on the phone and start sharing that. Perfect. Can you guys see my screen?
Yes.
Okay, perfect. So here is one thing. Yeah, that's what I want you guys to see, the whiteboard screen. Okay. Essentially, a bullish move will be accompanied by bullish momentum, and that bullish momentum will be followed by bullish volume, right? So let's say we take price and oh, I can't draw. Never mind, I fixed it. Okay. So if price moves up like this, right? And then price, you see that because of the time to price ratio, you see that momentum is favoring you, right? So you're essentially moving up. You're in an uptrend. Perfect, right? You have all your confluences. Perfect. Now, what if you see on the bottom, what you should see at the bottom is high volume, or something more like this in volume, okay? You should see volume spike. You should see high volume here. And essentially what that volume bar will look like is it should look like it'll be a bar chart, but it should look something like this. And it should hold structure right there. Like that, right? On a move up, that's usually what volume should look like, because there is supported volume for you to see the price actually moving up. Now, here's a new concept that I'm going to give you guys. What is the concept of price being supported or being unsupported? Well, it's very simple. Essentially, the concept of price being supported or not supported is momentum and volume on your side. If you have momentum on your side and you do not have volume on your side, that move is called a diverged move. Okay, so let me show you guys an example of a divergent move. And essentially what that divergent move shows is that you no longer have a willingness to go in a certain direction. Okay, so let's look at an distribution schematic, right? Let's say that we're going up here. Perfect. Now you have this, right? The UT coming back down. Perfect, right? Momentum is in our favor, right? Momentum is in our favor. Why is momentum in our favor? Because our time to price ratio is positive, right? Our time to price ratio is positive. Now, let's say that volume down here, spikes. It's doing okay. Now, when it drops, volume spikes. Okay, let's say volume spikes when it drops. And then there is very, very little volume when price moves up. So if there's little volume when price moves up, but there's high volume when price goes down, you essentially show the willingness of a move to actually happen. This is called a volume shift, okay? When price is moving in a certain direction and there is no volume, that is called a volume shift. And that essentially shows an intraday move where you can take volume and you can use it as a confluence to show that price is no longer supporting that move. This happens very, very importantly on sponsored or mitigation candles, okay? Because usually they will have no volume behind them. They will literally just be the banks letting go of a bit of gas and price returning to a certain point, targeting structure, and then dropping, okay? So let's say we look at this position right here, right? This move to the upside right here will show us that price wants to go in that direction. However, it will also be conferred by our volume down here, or confirmed by our volume down here. So let's say that when this move happened right up here, when this move happened right up there, volume shot. Volume shot. But as soon as this move started right here, and let's actually change the color for that so we can tell the difference. Right, as soon as this move started right here, what ended up happening to volume is it started dropping. Right, all the way until it came back to that point. And at that point, we see volume, right, during this move, we see volume spike again. What is this called? What is this upward move? What is it called? It's called an unsupported move, right? Momentum may be on your side, but if volume and momentum don't agree, then that confluence is, then that move is incorrect, right? That move is not sponsored by the banks. It's the banks letting go of certain positions, breaking this up here, which is known as what? What is this high known as? How do you mix Wyckoff and liquidity?
The spring.
No, those are buy stops, right? It cleared buy stops, and it gave you a
Thrust
perfect
after
entry.
distribution.
Yeah, upthrust after distribution, right? This already distributed, it upthrusted one more time to take out buy stop liquidity, and then from there dropped. What was our confluence? Our confluence was one, momentum, right? Price range, price time ratio. It takes a lot longer for price to make its way down. For price to make its way up rather than making its way down. Why? There's less volume. If there's less volume, that means less volatility, which means less pips moved during a certain amount of time. Okay. Now this is true in structure. For mitigation candles, this is also true. There should be very little momentum behind them. Now, how do we also, like for example, let's say that price does something like this. Does everybody understand this concept, by the way? Does everybody understand this concept of time to price? First off, so let's recap everything that we've learned right now, right? Everything that we've learned, let's recap it. First, time to price ratio, right? Talking about momentum. So remember that if it takes longer for a move to go down, let's say it takes 24 hours for a move to go down, but it only takes 7 hours for a price to move up, where's momentum favoring? Where's our time to price ratio better?
Up.
Up, right? It's favoring the upthrust movement. Why? Because momentum is now on our side because of our time to price ratio theory. Perfect. Now, second theory that we looked at today is volume divergence or volume profiles, right? Meaning that if volume is supporting a move, volume should spike along with the move. So you guys see how volume spiked right here, and you see how the move moved downward. You see how volume spiked, how volume actually stayed flat as a spike up happened, which created our UTAD, or upthrust after distribution, right? Now the next downward move, which ended up creating our test, was unsupported. Whoops, was unsupported. Why? Because price doesn't want to go that way. If we look at our time to price ratio, it takes a lot more time for this test to be created than if a downward position was made. Okay. Now, once we've mitigated this, we move on to our volume profiles. Does everybody understand these volume profiles? Really, volume profile is very, very easy to understand once you pair it with time price ratio. Okay. So you look and see how many candles or how much time, how many bars it took for price to go from point A to point B, and then you get your ratio, right? You can divide your time by, you can divide your price by your time, okay? And then from there, you can do the same for volume. Volume, all you really want to do is you want to check whether or not a move was supported by volume or it was not unsupported by volume, okay? And I'll show you an example of what a supported move looks. Okay, a supported move looks something like this. Now, a lot of you guys will hear me calling this exposed liquidity, which is perfectly fine. It's technically the same thing, right? Let's say price ends up leaving something like this. Can anybody tell me what they think volume will look like if this is exposed liquidity? Can anybody give a guess to say how volume will actually look like here? Who can tell me what the volume profile will be?
Low.
Low. Why do you think the volume profile will be low?
Well, because it shot up, but it doesn't want to go up.
Right, it shot up. Let's say it didn't target any liquidity. Let's say it didn't target anything back here, right? But it just shot up. What ends up happening? Price is inefficient here. So this volume profile is obviously going to look, like you said, is going to be unsupported. Right? But what's going to happen when price comes down, starts accumulating, hits its last point of supply, your entry's right here, your stop loss is back here, right? Low drawdown entry with your target above this liquidity that needs to be taken out. Perfect. Now, what are you going to look for? You're going to look for this liquidity to get covered. Now, let's say momentum starts being on your side. What do you think volume's going to look like right here? What is the volume profile going to be once momentum is on your side? Volume is going to spike up with you. Since volume is going to spike up with you, you know that this move is now supported by your two time price confluences, right? Because what is our third law? That time and price correlate. You will hear a lot of people say that time and price are not related, or that time knows no price, but this is evidently, well, it's not true in certain senses, but it is true in others. Give me one moment. Okay, I'm back. So essentially, right, going back to what we were talking about, momentum and volume need to correlate. So here's another law that we're going to be applying into our trading. The new law is going to be our sixth law. And our sixth law essentially states that momentum and volume must correlate. Well, must agree for price to continue. There you go. Does this make sense to you guys? And if you guys want to backtest it, you definitely can. This is something that I've backtested for a very long time. When there's exposed liquidity, right, and when liquidity shoots up and doesn't want to go that way at that moment, there will be low volume. However, when price shoots and volume accompanies, that is where price wants to go. Banks can do whatever the hell they want from point A to point B if you have, like, if you don't notice volume. But as soon as you start noticing volume profiles and you start realizing when liquidity is exposed and when it's not, a lot of people will call it a stop hunt, or they will call it a run on stops, or a liquidity fill, or whatever they call it, right? They haven't looked at volume, because if they would see that volume down here does not correlate with the move up here, that means that there's something fishy going on, right? Because volume counts for bank entries as well. It counts it in units of price, or in units of currency being entered into the market at one point, right? Because, oh wait, actually, I never actually even covered this. Do you guys know what volume even is? Volume, to put it very, very simply, volume is the amount of units currency currently at trade in the market. Okay, so volume, let me actually write that definition down for you guys. I just assumed you guys knew it. So volume is units of currency. I'll just put dollars, right? Per time. Actually, no.
You actually went over it. I think it was bootcamp 1 because I have it written down. It says how much money is in the market at a time.
Oh, perfect. I wrote part 1. Whoops. Traded at one time. There we go. So I'll just reiterate it right one more time. Volume is essentially just the units of currency traded at one time. Okay. So each bar is held per a certain unit time, right? So each one of these bars is, let's say we're on the 1 hour, would be 1 hour, right? So when you guys take out your ruler on TradingView and you guys like expand it from here to here, it will say like 24 bars. That essentially says 24 bars of volume, right? And those 24 bars will show essentially how long, depending on your time frame, that it took for price to go that way. Okay, if that makes sense. So I'm glad that makes sense to you guys. Now, is everybody with me so far? Because we're about to go into inefficiencies and liquidity pools, or sorry, liquidity targets. So does everybody understand this so far?
Yes, sir.
Okay, perfect. Now I'm going to give you guys a choice. Do you guys want to go with a little bit simpler of a unit, or do you guys want to go with a little bit more in depth? Do you guys want to go over liquidity pools and inefficiencies, or do you guys want to go over pair correlation? We're going to cover them either way, but which one do you guys want to cover first?
Let's go with liquidity pools first.
All right, let's go over liquidity pools first. All right. Essentially, to understand liquidity pools, we have to understand inefficiencies. But we also have to understand what we covered in part 1 of bootcamp, which essentially was bank logic, right? So for there to be a position to sell, there has to be a position to buy, right? So let me kind of run it for you guys right here. So for there to be a position to sell, there must be a position to buy, right? Let's say price starts dropping here. Actually, let me draw it a little bit better than that. Okay. So at this point right here, what did banks have to do to pivot price? What the hell? What did banks have to do at this point to pivot price? They had to enter, let's say, for example, like, right, let's say that we target this with the star, and now let's put it over here, right? Let's say they entered at 900 million lots for a sell, okay? But let's also say that they entered 300 million lots for a buy. That shows essentially our third law of, our fourth law of trading, right? Which is the laws of supply and demand. There has to be a willingness to buy for there to be a sell, right? And there has to be a willingness to sell for there to be a buy. So if price wants to move downward, there has to be a willingness to buy as well at this point, right? At our star point right here, at our top point. However, there can be a certain position in time where the banks move so fast and inefficiently that they actually cannot get as many entries as they want. Okay, so that is considered, that is known as inefficient pricing or inefficient delivery, right, by the algorithm. So this inefficient delivery will essentially look something closer like this to lots, right? So let's say we're rewriting our lots, right? And let's say you got 900 lots in a sell, but let's say you only got 50 million lots in a buy. That means that price is heavily shooting down. And if price heavily shoots down, that's very, very inefficient pricing, because as you guys know from bank logic, banks do not just like to get price up here. They like to get it on every single retrace. Right here, right here, right here, right here, right here, right here. Because a lot more people get stopped out at every single point. So they gain more liquidity. If they cannot capitalize on said liquidity, what are they going to do? They want to go back and come back up to that entry and actually fill that inefficiency, get some more lots in, and stabilize the market. Now, this goes back to our theory that says that the market likes to stay in equilibrium. Right? Market stays at equilibrium. Market likes equilibrium, right? And if you are not efficient from this point to this point, where do you guys think price is going to retrace to? Possibly using a sponsored or a mitigation candle? Where do you guys think price is going to return to? This is not the same thing as an order block.
50% of that inefficiency.
The 50% of the inefficiency. Perfect, TJ. You've been paying attention. What the? Whoops. There you go. 50% of that inefficiency. So 50% of this inefficiency is targeted by price. And if you backtest this and you look at your own inefficiencies, you will find that price either retests the 50% of that inefficiency, the 79% of that inefficiency, or it will completely cover by either a wick or a body through that inefficiency. Okay, so here are a couple rules. Does everybody understand why banks sometimes may be inefficient and why they even care about being inefficient? Because they want to maximize their profit off every algorithmic move, right? And they can't get as much liquidity if they don't stop people out. And if they don't stop people out, they can't get liquidity, right? They'd have to put in their own money, which they don't want to do. So everybody understands this right side, right? Everybody understands why banks need to be efficient? I'd rather you guys speak now. Yes, yes, yes,
Yes.
yes. Okay, perfect, awesome. Let's go to the rules. Let's go to the rules. So we can get rid of this. Okay, let's go to the rules. For inefficiencies, usually there will be gaps between a candle and its descendant or its predecessor, right? Whatever you want to call it. So let's say a lot of times you will see candles, right, that will drop, but then you will usually see like a candle or like a wick kind of mitigate through it. Okay, so usually you'll see like a wick right here, like mitigate through it, then continue on downward. Then you see like another candle mitigate through it, and you see it mitigate downward, right? This is known as efficient pricing because banks can mitigate their own losses and their own buy positions, right? If price is going down in this case, since price is going down, they're going to mitigate their buy positions as they go down. So price doesn't even need to return to this place because price has already been mitigated. Okay, this is known as efficient pricing. Okay, and in comparison, what inefficient pricing would look like is something like this. Inefficient pricing will look something like this. All right, let's say there's a drop, and then price just mitigates like that, and then keeps dropping. Okay. Essentially, from this right here, actually, let me delete that and let me draw it another color. From here, oh my goodness. From here to around here, there's a gap in price. Okay, and that gap in price is known as an inefficiency, a liquidity void, a fair value gap. Well, a fair value gap has a couple different things, but essentially it's the same thing, right? It's a void or a gap in liquidity. And that gap or void in liquidity will show you how price and where price will return to. So under what category of strategy is this going to fall under? It's essentially going to be a range finder tool, right? But it's not a range finder. It's a mitigation tool. Okay, so remember how we had the couple different categories of tools, right? How under rangefinder we've had order blocks, we had our premium discount arrays, and we had our fibs, right? For liquidity voids or inefficiencies, I tend to call them I literally just call them bank logic. I use them as a mitigation special type thing, right? So I know where price is going to head back toward. It's something known as a liquidity target. Okay, these are liquidity targets. Why? Because price will eventually, whether it be in the future or immediately, price has to fill this gap because there is a big inefficiency there. And the algorithm always targets inefficiencies because it doesn't like to be inefficient, because the market stays at what?
Equilibrium.
Equilibrium. Since the market likes to stay at equilibrium, it has to come back and mitigate this inefficient pricing, which will tend to look something like this. Boom, wick, then it come back down. Okay. If you want to backtest this, you can. This is a very, very simple concept. Okay. So let me give a couple more examples of inefficient pricing. Let me see if I can find one really quickly on TradingView. Let me see if I can find one and see where inefficient pricing actually took place. Because this doesn't happen very often, but when it happens, it mitigates very, very well. Actually, there's one example right here. And another thing about mitigation is that it can happen within any position, but you have to kind of keep in mind where price is going toward, so that it can actually be an inefficiency. And here's a couple rules for you guys. So one of the main rules is that, do you guys remember the left-right rule that I taught you guys a while back? How if liquidity mitigates another piece of liquidity on its left, on its immediate left, it is considered a mitigation candle, and it is no longer considered exposed liquidity. Do you guys remember that, or do you guys want me to go over it again?
Can you go over it, please?
Yeah, I can go over it one more time. So essentially the left-right rule that I taught you guys, right? So the left-right rule is, let's say there's inefficient pricing to the left, right? Let's say that there's very, very inefficient pricing to the left, right? It just drops. Now it mitigates and then it comes back up, right? If price decides to come back down and mitigate this, it is mitigating this position, not this one, right? Why? Because what was the mitigation of this position, of this one right here? What was the mitigation of this inefficiency right here? This one. This position was what mitigated it. So this right here can continue on up without any problem, because it no longer needs to mitigate this, as this was the mitigation of this previous one. Does that make sense?
Yes.
Are you sure? I need you to understand this to like a T.
So the move up is already mitigating the middle one?
Yeah. So let me explain it a little bit more simply. Okay. So essentially, let's say there's mitigation to our left, right? Let's say there's inefficient pricing right here, right? Let's say there's a gap, right? Right here. If price shoots up, I'm changing colors and it's very hard to on this phone. Right? If price shoots up right here and leaves quote unquote exposed liquidity, but there is no volume here, what can we assume about this candle? What type of candle is this? The sponsored
Unsupported.
candle. Why is it not unsupported? Even though volume is low and momentum is against you, why is it not unsupported?
Because it's targeting previous structure.
Because it's targeting previous structure. Perfect. Since it's targeting previous structure, you essentially don't consider it an unsupported move, because that move was meant to happen. Right? Now, even if this looks like exposed liquidity, it isn't exposed liquidity. This is what I mean by the left-right rule. Because this candle that was quote-unquote inefficient filled another inefficiency. If an inefficiency nulls an inefficiency, so let's say, you know, like, let's go back to basic math and use basic math to kind of solve this. If a negative, how do you negate a -1?
Add one.
You add one. Right? You add one. So essentially, this negative one right here, we have a negative value at the top. You want to add one. Okay? Does that make sense? Like is that a little bit better of an explanation for you guys? How if price mitigates itself, it isn't considered an inefficiency. Does that make sense? Because if we want to kind of use a little bit more math here, we can put it a little bit more simply, okay? What happens if you multiply a -1 and a -1?
Turn into a positive.
Turns into a positive one. Well, actually, without the parentheses, but it turns into a positive one, right? So right here, we have a -1. We're multiplying it by this other -1, right, to mitigate these, and now price is back at equilibrium, which is positive, right, because equilibrium is always 0 or positive, right? And then now what can price do? Now that price is efficient again, what can price continue doing? Go in its positive direction, which ends up being a downward slope, okay? So for these liquidity targets to actually get hit, right, for these inefficiencies to actually get hit, it doesn't matter if the candle that mitigates it is inefficient, because it will be mitigated by itself. You don't have to worry about it. Okay, it's mitigated by itself. Does that make sense to everybody?
Yes.
Perfect. Okay. Inefficiencies can show up in a variety of different moves, okay? They can show up in many, many, many different moves. So for example, let's say that a candle ends up moving something like this, right? Let's say it ends up moving something like this. And then a candle drops like that. And then this other candle only drops like this. Where is the inefficiency right here? The inefficiency is right here, between the wicks. Between the wicks where there is just one clean body. That makes sense?
Mm-hmm.
Okay. Now these positions are caused by there not being enough positions to actually uphold the move. Okay. So like I said before with bank logic, right, there is not enough, in this case, buy positions for price to be efficient on the sell. Okay. For everybody that understands bank logic, does this make sense to you?
Yes.
Yes? Okay, cool. So price must maintain equilibrium. It also must maintain price efficiency. Okay. So let's also look at another example in which I'm already drawing. So now that price is going to come back and mitigate this, it doesn't need to take a super long time for price to mitigate it. What it can do is on the next candle, it can do something like this, right? And then close out with a wick like that. Okay, and then it can continue on downward. Okay, and now when it does that, it just mitigated this inefficiency, and you could have gotten a very, very low drawdown entry based off of the 50% of the inefficiency. Okay, now sometimes it doesn't immediately mitigate itself. Sometimes it takes all the way to the other side of the freaking chart for it to come back up, mitigated, and then continue down. Now let's think if there is high momentum behind these moves, right? But maybe there is high volume behind those moves. What if we look at this through distribution? How can we mix this with our main strength, which is Wyckoff? How can we use this? Let's say that we're looking on the 1 minute from an entry, right? Let's say we're looking for the 1 minute for a 1 minute entry, and let's say you have a sign of weakness, right? Let's say you end up doing something like that, right? Having our up thrust, and now you have a sign of weakness, right? Because it broke our low, Once you break this low, you know, and let's say there is high volume on this move, right? High volume on this move. You also have positive. You have positive time price ratio, right? You have positive time price ratio and you have high volume, which means that both momentum and volume are on your side. Now you have an inefficiency, which ends up being from where to where? From here to wherever price didn't mitigate. So let's say there's a wick right here. Price will have to mitigate from there to there. Now you want to target the 50%. Perfect. Sometimes price will be so efficient that your inefficiency will sometimes be up here. It will be one of the first candles that dropped on the 1 minute. Why? Because, you know, whatever reason, the first few candles were the ones that slipped up, but then the other ones ended up covering for themselves like so. Let me show you an example of how it looks when a candle covers itself. So let's say a candle, whoops. Let's say a candle moves like this, and then the wick covers it, right? This previous wick is covering the previous one. This candle's like that. This candle's like this, right? And there are essentially no gaps in price, right? There are no gaps in price. Either previous structure is mitigating it, or it is mitigating another piece of structure, right? So here's the example that I wanted to give you guys. Actually, I remembered it. So let's say price ends up making a big inefficiency right here, right? Then comes back down and becomes inefficient again, then comes back down and it keeps going. Why does this inefficiency not need to be retested? Because it mitigated this inefficiency. Okay, so this inefficiency right here was used to mitigate this one, which means that you do not need to mitigate this inefficiency anymore. You can continue on going down. Okay, that's what I wanted to say. I just remembered it and I thought I'd throw it in there. So now, going back to this example, if you're using Wyckoff on the 1 minute, where can you expect price to come back to? At least to 50% or a little bit higher. And then give you your money. Why? All based on an inefficiency. Okay, so this is another thing that you guys should be watching for. Not just order blocks, right? Maybe there is an order block up here. Maybe there is an order block up here, but later I will go into the hierarchy of price, right? And the hierarchy of price is essentially, if there's an order block and an inefficiency, what should you look at first? What should you target for least drawdown? Okay, and that will be on day 5 of the bootcamp. Okay, so does everybody see how a sign of weakness or an LPSY can be inefficient? Because a sign of weakness is a lot of times something that will be mitigated in the future, right? Because it's inefficient. So I don't know if you guys remember my GJ trade that I was showing you guys. A lot of times price was inefficient at that point, right? Because you got a massive sign of weakness that left a giant wick on the weekly, right? It left a giant wick on the weekly. So what ended up happening to price? It actually ended up going up, coming back down, mitigating itself because it was inefficient, and then filling itself, filling this big inefficiency. Okay, does that make sense? How banks need to follow the algorithms kind of code, right? But banks themselves also want to get as many positions as they possibly can, so they must maintain price as efficient as possible. Okay, and that should also be one of your targets of position, one of your targets of liquidity. Okay, because this is something that a lot of people might recognize as ICT's sell or buy model. Okay, and I'm going to pop up a picture of them for you guys. How do I share these with you guys? Actually, you know what? I'm just going to draw them so that there's less confusion for you guys. I'm just going to draw them. Let me take out the picture that I had for you guys, because I actually had a picture prepared, but I wanted to draw it for you guys, so it's fine. Here it is. Give me one moment. So I'm going to go over two models, and they are known as the buy and the sell model, okay? And those buy and sell models will essentially give you as many liquidity targets as you can possibly take, okay? Now, reminder that I have to hard cut off at 10, so if you guys have any questions, make sure you guys are asking them as you go, okay? Let me go back to my shared screen, and let's start drawing them. Perfect. So these two models will essentially be models that you want to look for when you guys are looking for a liquidity target, okay? And you guys can use this on lower time frames, you guys can use this on higher time frames, but they all rely on you having a good understanding of liquidity, okay? So essentially there will be three phases to a sell model. We're going to go over the sell model first. Here's going to be the sell model, okay? And the sell model is usually ends up breaking liquidity in multiple places, okay? Let's start off with our zone right here. Let's say it starts off like this, okay? Heads up. Okay, now there's a couple pieces here that you guys need to focus on. First off is this bottom range right here. This bottom range is known as your target. This bottom range is known as your target, okay? So we're gonna draw a little. Why is this your target? Well, I'll explain here in 1 second. Right here at the bottom, we have sell stop liquidity. However, we aren't targeting it right now. We're targeting buy stop liquidity, which is why usually out of this range, it breaks this previous high. Right here, it breaks this previous high. It takes out liquidity and it comes back down, hits retail stop losses, right? Now it shoots back up and creates its phase two. Its phase two will essentially shoot back up and try to mitigate as much efficient pricing as it possibly can before it's shoot up. Now, after it shoot up, it creates the final model, which is something that you guys need to take into heavy consideration because it's one of the strongest things that you guys will ever encounter in your trading. Okay. Now, this right here, what do you think lies above this previous high right here? What do you guys think lies above this previous high right here? What kind of orders from big firms or from like, you know, big investors? What are they putting above these highs?
Sells.
Sells? They're putting buy stops.
Oh, my bad.
Yeah, right. They're putting buy stops. So what does price need to do one more time before dropping? As a one last FU candle, what does it need to do?
Shake them out.
Shake them out. So what are they going to do? They're going to take out this buy stop liquidity, and then they're going to take this. They're going to take out this low. Okay. Now, where's our target at this position? Our target is all the way down here. So what are you going to get as soon as you break this high? Where's your entry in this position? Where's your entry? Where is your optimal trade entry at this position? As soon as you what? As soon as you break this high, you can enter on a sell model. As soon as you break this high on a sell model, you can enter. Will there be a little bit of drawdown? Very little, most times. One of the guys that I was actually backtesting this with, he caught an entry on GU the other day off the 1 minute off a sell model like this. Okay, and he caught it as soon as it broke the high, and it gave him 100. It gave him 85 pips off of like with 15 lots. He dropped 15 lots at the very top, and he got 1 pip total of drawdown. I think 1 pip total of drawdown. Why? Because he fundamentally understood the sell model. Now we're not done with the sell model, but he understood the first part of the sell model. Now here comes the result or the aftermath, okay? The aftermath ends up being something like this. Comes back up, it mitigates, right? And then it continues. Mitigates and continues. And now down here, it actually goes below your liquidity or your target down here, right back here. And then it essentially does the same thing, right? So now where are your sections? Your sections are going to be right here. Your sections are going to be right here. Because price needs to retrace on the way down, right? And your final target will be below your previous liquidity. Now the screen won't actually let me fit it, but let's say that, you know, this is below, right? So this is below your target. So you know that you have to target this sell stop liquidity. However, since you're taking all of this buy stop liquidity, where are you going to use it? You're going to use it in expressing your desire to get, so your desire to sell, and target this this sell stop liquidity in a much stronger fashion. So what should you be doing? You should be targeting these lows, which target previous sell stop liquidity. Okay, does this make sense? So it's something
Yes.
a little bit different than Wyckoff, but remember that Wyckoff won't happen all the time. Wyckoff will happen most of the time, but sometimes it won't. Right? Sometimes it's not that it fails, it's that it just doesn't show up. Right? Or it's a variation. For me, this top peak is a variation of Wyckoff. Because I know that up here where the buy stops are, that's the buying climax. And price must break the buying climax to be considered a good UTAD, right? But now knowing what I know about this sell model and knowing what I know about Wyckoff, what am I going to be mixing? I'm going to be mixing these two so that if I see that price made a buying climax but actually never went back up and retested it, and I see that we're in the middle of a sell model, what am I going to do? I'm going to wait for price to break that buying climax, form a UTAD or a UT, right? Maybe give me a test. And if it gives me that test, perfect. I'll take that entry. Low drawdown. Still, our signature 3, 5, 7 pips, right? Very, very low drawdown. Entry off of a position that mixed Wyckoff and our sell model. Why? Because we know that that buying climax must be broken for that to be good and signature distribution. So what should you be doing? If you recognize a sell model and you see that that there is a buying climax without an upthrust yet, what are you going to do? You're going to target that upthrust, and as soon as it breaks out of that range, triggers those buy stops. What are you going to do? Boom! You're going to get into a sell, very low drawdown, put your rent on it, and you will end up with a flipped account. Why? Because you also have very, very low drawdown. Okay, it shouldn't blast off past that, it shouldn't blast off past this point and keep going 100 pips. That's not what you should be doing, right? Then you recognize the structure wrong, right? It should be holding that. It should just barely tap it and then come back down. Okay, that's what it should be doing. However, if you're more of a safer trader, you can wait for the test. That's completely fine. And then you can get it that way. That makes sense.
Yeah.
Now, essentially, you guys see this sell model. And what do you reckon? What does this look like?
I have a quick question before you proceed.
Yeah.
So when you said it breaks through the top to enter, would the same thing apply if it were in the channel, or is this usually only in like flat horizontal type
What do you mean
structures?
flat horizontal type structures? Well, most structure is flat or horizontal.
Got you. But you were also showing how it can accumulate and distribute along like slanted channels. Would the same cell model apply in the slanted channel?
No. So remember that that's for redistribution and reaccumulation, right?
Got you.
So if you can see reaccumulation within this point right here, within this, right? Oh, whoops, I'm not drawing. Within this right here. And you can see redistribution within this point right here. Right? But you
Yeah.
don't need to. It's not really necessary because price is moving in that direction. All price is moving horizontally. It's just moving how far up. So think of it like an axis, like a grid, right? Price is a grid. It's not just a horizontal plane or a vertical plane. Right? So that's essentially what it is. Now let's go over the buy model. This is going to be the buy model. Make sure you guys are muted so that you're not a distraction for your peers. Thank you. Now the buy model will be something very, very similar. As usual, your first position will be your target. Okay. Now standing out on this position, right? This is our first part, right? This is the lead up. So what is this right here? What is this going to be if this is our buy model? What is our first section going to be? What is our first section going to be? What is this known as? A target, right? It's going to be our liquidity target. Why? Because above here we have buy side liquidity. Now our second sector is again making sure that price is efficient, mitigating as much as it can on the way down. It can also be redistribution, however you may want to consider it. And then here is where our pivot point starts. This is where our pivot point starts. And this pivot will essentially help you grab the concept of liquidity and shoot it up, right? So off of this position right here, what do we expect price to do? We expect price to break, right? Because at this point, we haven't had a spring. So what do we expect to do? We expect to clap this sell side liquidity. And then once we do that, we are free to go back up. Whoops. We're free to go back up. Here comes that retest. Here comes that retest off that breaker. And continuing on upward, here comes our last target, which ends up being above our target liquidity. It ends up being above our target liquidity. Right? Since it ends up being above our target liquidity, that means that our target was hit. Our TP was hit off of this buy model. Now our sectors on the way up will be this breaker, and this final target. Does that make sense? Now, I use these buy models and sell models as kind of targets for where my Wyckoff is going to take me, right? So for me, maybe Wyckoff gives you a bit of a later entry or a safer entry, right? But what you can do is you can mix both of them. You know that price needs to have the spring right here. So what can you wait? You can wait for this to come down. Now, funny enough that you may mention it, funny enough, since time and price correlate, and there was our Asia range theory that we covered on day 2, what time zone, what Forex trading session do you think this took place in? What trading zone do you guys think this took place in?
New York.
No.
London?
No.
LA.
Asia, right? Asia is when it broke.
Dang.
Asia, because when Asia broke, right? When Asia is when essentially when the Asian range is created, you want to target both the low and the high. Whichever one is targeted first will essentially be where, you know, mostly price will end up going, right? Because it wants to mitigate itself. So right here, right down here, our high was broken, right? Our high was broken. Buy stop liquidity was taken out, and they got stopped out down here. When they get stopped out, now the sell side liquidity gets targeted, and they get stopped out. That makes sense?
Yes, sir.
Perfect. Does everybody understand this?
Is this the IPDA from ICT?
Yeah. So IPDA. So as I said in the beginning, this is I gave credit to ICT that this is where that's where I learned it from. But this is something that you can use in Confluence to your Wyckoff, right? Because say down below at our target, right, at our pivot point in our Asia range, that shows accumulation or a variation of accumulation. What are you going to see? You have to know where to target or where to take profit from your actual position. Usually that will be above your buy model target, right, which is all the way at the top, our first green section, right? And price will usually do this every single time. It will do it every single time. Now, this is where trends come from, right? A lot of people use quote unquote trend lines. This is where trends come from, because once it's done that, what can we target? We can target a retest, and this is also where bank logic comes into play. Okay, so we broke above our high. My pen just fell. We broke above our high, but what happens? We still have operations from the banks down here. So what do we have to mitigate? We have to mitigate as many losses as we possibly can, and then continue on our way up above this target, which I think you can pretty much see where people got the idea of trend lines from, even though they're fake. That makes sense?
Yes.
Does anybody have any questions at this point? Any questions at all? Makes sense, makes sense, okay. Perfect, perfect. Let me see what else we had to go over today. Sponsor candle mitigation, fair value gaps, finding entries, combining it. Okay. I think that's where we're gonna leave it off. I think this was a pretty good class. Your homework this time is going to be backtesting your volume and momentum. It's going to be backtesting this buy and sell model. And it's going to be essentially proving these to yourself. Now, in my group, we do something called case studies, which essentially you pick a pair. You pick a pair, and I'll give you an example right here. So you pick a pair, right? Let's say we do EA, right? Let's say we do EA. And essentially you say, okay, I'm going to backtest this point, and I'm going to say, hey, price did this, this, and this right here. Price did blah, 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 blah right here. I'm going to see essentially where price is going to target next, right? I'm going to see where price is going to target next. And here's actually a pretty good example of a sell model, even though it didn't hit below, but we have our first accumulation point. We have our first, second, and then we have our consolidation, right? And then from here, it ended up dropped below, and targeted the equal liquidity, right? Perfect. That's just a quick example. But so whenever you guys are trading, try to look for inefficiencies. Try to see where you guys see how efficient this pricing was? price was mitigated right here. Price was mitigated right here, right here, right here. Oh, here's a perfect example of an inefficiency. Where's our inefficiency from? Our inefficiency is from here
In the middle.
to here, right? Now, where did price mitigate it? Right here. Where's our 50%? Our 50% ends up being somewhere around right there. And if you would have placed your target, if you would have placed your short position off of there, boom, and then boom at the close of the candle, you would have gotten a 14 or a 15 pip stop loss for an inefficiency fill. And then you could have targeted the equal lows, which would have been perfectly within your sight, I think. Yeah, you could have targeted these equal lows, which would have been almost 200 pips off of a 15 pip stop. Actually, let me see where the actual target was. It was right here. So it ended up hitting, yeah, 174 pips. 174 pips before it retraced back to this point, which I have already taught my students. My students, I made a video on this. Who actually watched this video? Who actually watched this video? It's in the Technical Focus channel. Who actually watched this? What are these lines that I have drawn up here? Are they just random lines? Or what are they? They're not random lines, are they? The 1.625?
Quarters.
Perfect. Good job, Enrique. They're quarters. And where'd it go? It perfectly came back and targeted our minor quarter. Came back up, targeted our major quarter. Well, actually, no, this isn't a quarter. No, it's not. It's just an actual point. And then came back down, right? Stayed within this range. Perfect movement. Perfect. So case studies, essentially going back to our point, is when we take a certain pair and then we end up backtesting it, right? So let's say you backtest it. Let's say you backtest this distribution that happened up here. You mark it and then you open up a new Google Doc, right? And then you say, okay, case study for Euro AUD, then you put your date and then your name, right? And then from there, actually, do we have an example of one of these? Yeah, I think we do. I'm going to use Isaiah's example. Isaiah, do you have your example? Oh yeah, he does. So he has a BTC USD and a Euro JPY for case study. Here we go. So
P150 Isaiah.
Yeah, P150 Isaiah. So you see how Isaiah made this case study? He said Euro JPY full case study by Isaiah. Perfect. He puts the date. Perfect. Now he's when you're doing this study analysis, you will always use the top-down strategy, which means you will start with a higher time frame, try to identify structure in the market phase, and work your way down into smaller time frames for better entries. Weekly time frame. So he starts at the weekly time frame. Perfect. Now what does he say? He realizes that there is a distribution schematic. Now he realizes there's a distribution schematic. He recognizes it, and then he moves down a time frame. And now he says, okay, now when we look at the daily time frame, we're able to see distribution schematic on the weekly is followed by a completed accumulation cycle, right? Now let's go for the 4-hour time frame for a better view. Now when he goes up for this time frame, essentially what does he say? He says, well, when we're looking at the 4-hour time frame, it's clear to see that we have a distribution schematic forming. This leads us to conclude there is slight liquidity and inefficiency in the market. Let's take a look at the 2-hour time frame. 2-hour time frame shows the exact same thing, and he includes a good explanation below every single one of the time frames. 30-minute, right? And then he would go down and you could also go down to the 3-minute, right? And then he would explain how and where he is looking for his entry, right? Or if you're back testing it, you can say, this is where I would have had my entry because point A, point B, point C, point D. This is what I would have used. PD array, inefficiency targeting, whatever you wanted to use, you would explain it. And then you'd be like, okay, the sign of weakness was inefficient here, here, and here. And this is why I would have done this, this, and this. Okay, perfect. That's all you need to explain. Okay, but then that way your mind gets sharpened to these type of things, and the more case studies that you do, the more accurate you'll be, because the more patterns you'll see that are actually in the field. The more you dissect things that you see in the field, the better of a sniper you'll be, right? They don't train snipers on a computer. They train snipers by taking them out into the field, leaving them there for a week and trying to find certain targets. Right? That's exactly what you guys should be doing too. You guys should be throwing yourselves into the field and getting your hands dirty. So my homework for all of you is going to be do a case study. Do a case study, okay? By Monday, you should all have a case study. Okay, by Monday, you should all have a case study. I think that gives you plenty of time to get one single case study done. Okay, and I'll do one too with you guys, so it isn't unfair. Okay, so yeah. I'm going to go ahead and cut it off so I have enough time to prepare for my next meeting. But I appreciate you guys so much for coming. Please, if you guys have any questions, I would appreciate if you guys came and left your questions below, or DM me on Discord, and then get your questions as much as and I'll try to answer as many as I possibly can. However, please hit up your own mentors as well. Because that's what they're there for. So I appreciate you guys for coming, and thank you guys.
Thank you.